Fed closed out the third quarter up 20.81%, and the Nasdaq up 21.17%. September, which is a seasonally volatile month, surprised to the upside, with the S&P 500 ending the month up 2%, making it the best September since 2019. The rally was largely in response to the Federal Reserve's 50 basis point interest rate cut on September 19th, the Fed's first interest rate reduction since March of 2020. This starts a long-anticipated rate-cutting cycle. So why did the Fed kick off with 50 basis points in cuts? This was a highly unusual move by the Fed to cut so aggressively when the economy is growing strongly at a real GDP of 3% and a labor force at historically high employment, albeit slowing. Traditionally, a 50 basis point rate cut is done when the economy is under stress and/or there's stress in the financial markets or banking system. So then is this economy under stress, or is there stress in the financial system? In short, no. The Fed feels inflation risks are now skewed to the downside, and unemployment risks are skewed to the upside. It's all about risk management. This rationale by the Fed was well received by equity markets and provided comfort to investors that the aggressive rate cut was not in response to an accelerating deterioration of the economy or stress in the financial system. So what's ahead on rate cuts? Fed members signaled expectations for 50 points in cuts further this year, likely 25 basis points at each of their next two meetings. For 2025, the Fed anticipates a total of 100 basis points of cuts, and for 2026, the forecast is now down to 50 basis points. In short, more now and less later. The Fed is signaling a steady pace of cuts from here, barring any substantive shift in the data.
Although the Fed's focus has shifted to employment, let's be clear, the labor market is moderating and certainly not crashing. The all-important non-farm payrolls report will be released on October 4th and is expected to show growth of 150,000, following August's disappointing 142,000, of which 118,000 came from private sector hiring. Unemployment currently sits at 4.2%, down from 4.3% in July. As we sit at historically low unemployment, it's simply more difficult to continue adding jobs at a strong pace. The unemployment rate is now expected to end the year at 4.4%, up from Fed members' June forecast of 4%. Inflation is well on its way to the Fed's 2% target, with personal consumption expenditures, PCE, index sitting at 2.2% for August, which is down from 2.5% in July, and the lowest since February 2021. The slowing in the pace of inflation in the past year, prices still going up but at a slower rate, reflects the tightening of monetary policy in 2023 and 2024. U.S. consumers have been resilient and have more savings than originally thought. Recent data revisions estimate the savings rate at 5.2%, up significantly from the former 3.3% for Q2 2024. This means that personal savings are increasing, now at $1.1 trillion, another important indicator for a healthy economy.
Where do we go from here? We expect the equity markets will be higher by year end, but over the short term, we expect volatility given rising geopolitical tensions in the Middle East and the longshoremen strikes at the ports along the East Coast and the Gulf Coast. We are watching both risks very closely. The East and Gulf Coast ports handle 25% of U.S. imports and 27% of U.S. exports. That represents 2.8 and 1.9% of U.S. GDP respectively. If we go back to 2000, most transportation industry strikes have lasted less than 2 weeks. The larger ones tend to last less than a week, given the magnitude of impacts, i.e., negotiations are settled quicker. The geopolitical tensions in the Middle East are escalating. Surprisingly, the commodities market is not pricing in a widespread spillover into the rest of the region at this point. This could change should Iran move to block the Strait of Hormuz, which is a critical shipping route for 20 to 30% of the world's oil supply. While the humanitarian impact of wars and military attacks are horrific, history shows that geopolitical-induced equity market sell-offs tend to be good buying opportunities. Earnings continue to grow this year with an 8% growth rate, and S&P 500 profit margins have remained stable, landing at 12.6% for Q3. Price to earnings, or PE multiples, tend to expand as interest rates fall, and the current PE multiple on the market is 21 times earnings, which is certainly high by historical standards. So, with all of that said, we expect volatility in the short term, but any dip should be used as a buying opportunity, and we expect the market to be higher by year end.
Now to the all-important question, what about the election? We know that politics can bring out strong emotions, but as investors, we are wise to tune out the noise and focus on the long term. And historical data suggests that this is the right approach because economic and inflation trends, more so than election outcomes, have a stronger, more consistent relationship with stock market returns. In fact, if you go all the way back to 1933, the markets have trended higher regardless of which party's in the White House, and the S&P 500 has averaged strong double-digit returns regardless of whether we have a unified government, a unified Congress, or a split Congress. So if you're interested in more election-related and Washington, D.C. insights, and I think we all are this time of year, then be on the lookout for our next quarterly webinar on October 24th with Scott Eckel, who's the Legislative and Regulatory Affairs Managing Director at Charles Schwab. And don't miss Grace's next video, The Election. Does it really matter?
As always, thank you for placing your trust in our team. We wish you and your family good health and prosperity as we round out the last quarter of 2024.